Hi, Sally and Steve Smith. My name is Deanna Lambert, and Bob Booth asked me to go over the options that we have for the Cornelius stock and how we can protect your investment against adverse events. So we're going to have three options: a protected put, a covered call, and then an equity swap. So right now, let's go over the introduction, kind of go over some information about you that we already know. We know that the portfolio is not diversified, and that's what we're looking for. You have 1,000 shares of Cornelius stock plus a balanced mutual fund, but right now we're just focusing on the 1,000 shares. We know that you reinvest all dividends and capital gains so that you guys are not looking for income from this. We know that you expect a rate of return at 8.5. Your goal is to have a good risk management portfolio that's well diverse, and you currently have a pass score of 21. So a protective put is a type of contract. The premium is the fee, so that's going to be $2.70 per share. It gives you the right, but not an obligation, to sell an amount before a certain date. A protective put will have a certain price that it cannot go under, so you'll not lose additional money if the price falls under that predetermined price. And we all know that stocks rise and fall, so if something would happen and that stock would fall, if it falls underneath that price, we know that we're still safe. So this means that losses are capped or limited. Again, if it falls underneath that price, we're safe, we're protected, we know that we have a minimum that we are promised and guaranteed. And protective puts can be bought at any time. A covered call. Covered calls are a neutral strategy. They're used when you're expecting a minor increase or decrease in the price of the stock. It's used to generate income by selling call options. Again, we know that generating income is not really something you guys are looking for, but again, this is an option. It's a good option that can generate income. It's used for an investor who wants to hold it for a long time. So someone who's going to hold on to the stock for quite a while, they just want to use it for income, this would be a good option. Equity swap. Equity swaps are future cash flows without assets that are changing hands. So these trade over the counter and can be customized depending on what the parties are looking to get out of it. But because they're trading over the counter, we know that they're a lot more riskier than a protective put would be. Equity swaps are usually done by auto financiers, lending institutions, or investment banks. So these are large companies that you're dealing with. And it's similar to an interest rate swap, but deals with equity index instead of that fixed interest side. So right now we're going to go over the advantages and disadvantages of each option, and then we'll go over some examples of how transactions might look. So right now for a protective put, advantages, number one advantage, can be bought at any time. Also, protective floor price, like as long as you know you're guaranteed a certain amount, if the price falls, you're still guaranteed your amount no matter what's going on with the market. So that protective floor price, you're not losing money under that predetermined price. That's a huge advantage for a protective put. It gives you a right but not an obligation to buy by a certain date. I feel this is a good advantage because if for some reason you decide you don't want to buy, you don't have to because you're not obligated to do it. It has unlimited profit potential because, again, you've got that floor price. So if for some reason it falls underneath it, you're not going to have to worry about it. So all we're worried about is going up. And each contract equals out to 100 shares. So the disadvantages is you have to pay a premium. And we know our premium would be $2.70, which is like $2,700. Which seems like a lot, but at the same time, we know that we're not going to lose money beyond what the price is that they've set. The premium is based on time until expired, volatility, and the price of the asset. So depending on who you're dealing with, how long the protective put is put out for, what's going on with the market, how much it's priced at, is all going to determine what that premium really is. A covered call. So one of the advantages to the covered call is obviously generate income. It's an option for investors that want to hold out for a while, but they don't expect a huge increase or decrease in the price, and it can generate a maximum profit. I mean, that's really good. People love profit. They love income. So if that's something that you're interested in, I mean, this would be a great option. But the disadvantage is you don't have a price floor, which means you can lose money on it. It's not a good option for someone who's going to look at it short term. It's not a good strategy for an investor who's more of a bull or a bear tendency. So someone who's more aggressive with their stocks, this isn't going to be a good one. And again, can generate maximum losses because there is no price floor. You can lose money if the price falls. The price falls and you're going to have to eat it. Equity swap. The advantages, one of the major advantages to this one is it's customizable between the two parties. So depending on what the two parties want to get out of it, they can do what they want. The assets never trade hands and is traded over the counter, and it helps diversify a portfolio. However, the disadvantage is it's usually done by large financial firms, institutions, auto finance companies, and investment companies. Counterparty risk can happen, and assets never change hands. So it's in both columns. Like, it's a good thing, but also it could be a bad thing depending on what's going on with the market, how the swap is being done. If the market has fallen and you've ended up losing every quarter, I mean, that could be a bad thing. So a protective put for the transaction. So you have 1,000 shares of Cornelius stock, which is a $2,700 premium. However, Cornelius is currently at $28.87, so $28.87. But the strike price of the put is $29 even. So the put option would never go below that. So as soon as you buy into it, you're currently gaining 13 cents a share just by trading it. So it's a low risk option because you're gaining 13 cents in the beginning, and we know that it cannot drop underneath $29. So we've already gained, and we know we're not going to lose. So a protective put is a great option if we're looking at trading those 1,000 shares of Cornelius. A covered call. So a strike price of $30 per share, and then you earn $1.80 per share in premium. If the stock trades below 30 a share, it expires as worthless. But you would still own the stock and have the $1,800 minus the fees. The stock could fall and the option be worthless, but you would keep the $1,800 premium. Another thing that could happen is the prices rise above 30 a share, or $31.80, which is the strike price plus the premium of $1.80. You'd be better holding on to stock, and that would give you the extra $1.80 per share. It's a riskier option because, again, no floor price, and it could fall. It could fall below the 30, and it could end up being worthless, and you could end up owing, a little bit, those fees that they're talking about. So it is a bit riskier than the protective put. Equity swap. So this is the one where you're trading with a big business. Remember, auto finance companies, investment companies, larger financial institutions. So you'd be trading at a notional principal of 28,870 for the capital gain or losses throughout the year. So all 1,000 shares of Cornelius would be traded for the notional principal of that 28,870. And depending on how the market does will determine if you will earn money or owe money, because they'll look at each quarter, and depending on what the interest rate was or what it went up or down, that's going to determine what you get back each time or what you owe. So the risk is very high with this one because every quarter is going to depend on how the market's doing. If the markets went down, then you're going to owe. If the markets went up, then you'll earn. There's no price floor, so this one's a lot riskier than the covered call or the protective put. So we know each option allows unique advantages and disadvantages for the 1,000 shares of Cornelius stock. A protective put is the least risky because it has a price floor, meaning that you're not going to lose any money because the strike price is currently above the Cornelius Inc. stock price. A covered call would be a great option if you've decided that you want to generate income instead, but it still can be a bit risky if the market falls. An equity swap is the most volatile as the payments are based on how the market is doing. Again, if the market's doing bad, then the stock is doing bad and you're owing money. You may earn money in one corner and then lose it all in another. However, the market may rise and you may make money in all 4 quarters. You just never know with the stock market. So for my recommendation, we're looking to diversify the portfolio and get rid of some of the risk. Because you don't require a high level of income, I believe the best option for the Cornelius, the option that we should do is the protective put. It gives us that price floor, so we're not going to lose money beyond the $29 per share, just in case the stock market falls. There's less risk with this one than the other two, again, because that price floor. The other two don't have a price floor, so they're just basically based on what the market is doing, and if the market's doing bad, then they're doing bad. Again, if they're doing well, then the covered call and the equity swap would be doing a lot better, but we don't want to lose money. So because we don't want to lose money, we want to make sure we're getting something back. I think that price floor on the protective put is our best option. Yeah, I mean, while the protective put depends on what the market is doing, the price floor is going to protect that investment, and that's going to be my recommendation. Thank you so much for coming in today, and I hope to speak to you soon.